Every once in a while, you come across someone whose story is so unusual, you almost don't know what to make of it. Martin Armstrong is one of those people. Depending on who you ask, he's either one of the world's most remarkable economic forecasters or one of the most controversial. You see, years ago, he built a computer model designed to identify major turning points in the global economy. Over the years, that model attracted the attention of hedge funds, multinational corporations, financial institutions, and even governments. Then something happened that sounds more like a movie than real life. Armstrong refused to turn over his computer modeling system during a government investigation. What followed was a legal battle that eventually landed him in prison for years. Even today, people continue to debate exactly what happened and why. Regardless of where you come down on the story, one thing is hard to ignore. For decades, people with enormous amounts of money have wanted to know what Martin Armstrong's computer model was seeing. So when I recently listened to one of his latest interviews, I wasn't really interested in another prediction about stocks or gold. I wanted to understand the bigger picture in his point of view. What does someone who has spent decades studying economic cycles think is the next major risk? And after listening carefully, I don't think his answer is what most people expect. Because according to Martin Armstrong, the next financial crisis isn't really about the stock market. It's about something much bigger. Debt. Government debt. I know, no big surprise there, but his reasoning and outlook will shock you. In this video, I want to walk through his thinking, where I think he makes some very compelling points, where I think we should all be a little cautious, and why I believe every person should at least understand his dire warning. Let's talk about his famous prediction computer. One of the things that makes Martin Armstrong so different is that he doesn't approach the economy the way most economists do. Most economists start with a theory. They build models around inflation, unemployment, interest rates, consumer spending, and then they try to explain why something happened. Armstrong went in a different direction. Years ago, he built an advanced computer model that wasn't trying to predict one market or one country. It was looking for patterns in human behavior, in capital moving around the world, patterns that seem to repeat over and over again throughout history. I've always believed that numbers tell a story. Sometimes they're messy, sometimes they even seem to contradict one another. But if you step back far enough, patterns do start to emerge. That's really what Armstrong has spent most of his career doing. He isn't overly concerned whether stocks are expensive or whether inflation will come in a little higher next quarter. He's asking much bigger questions like, why do financial systems eventually break down? Why does money suddenly leave one country and flood into another? Why do governments seem stable for years and then all at once begin to struggle? Whether you agree with every conclusion he reaches isn't the point. Those are good questions, but he kept coming back to one subject: debt. Government debt. In his view, that's where the real story begins. And I have to admit, the more I listened, the more concerned I became. Martin Armstrong says debt isn't a problem until it is. When most people hear that the United States owes $40 trillion or that Europe and Japan have accumulated enormous amounts of government debt, the natural reaction is to ask, how are they ever going to pay it all back? But that's not really how government or sovereign debt works. Government debt usually just matures, and then new debt is issued to replace the old debt. It's a continuous process. Existing bonds mature, investors are repaid, and new investors step in to finance the next round of debt. That's been happening for decades. In fact, you could argue that's how modern governments function, which means the debt itself isn't necessarily what causes the crisis. Systems can continue operating with very large amounts of debt for a surprisingly long time. Armstrong's argument, though, is that the real risk appears when confidence begins to change. Because at that point, the question isn't whether governments owe too much, The question becomes whether investors still want to finance it. I think that's an important distinction. It's a little like a business that has carried a large line of credit for years. As long as the bank is willing to renew it, the business keeps operating. Customers may never notice anything unusual. But if one day the bank decides not to renew that credit, now the problem isn't the size of the loan, it's liquidity. Everything changes and the business owner suddenly has a big problem. Listening to Martin Armstrong, I kept thinking that maybe we've become so accustomed to hearing about record government debt that we've almost stopped asking the more important question. Not how much do they owe, but who keeps buying it? Because every Treasury auction, every government bond issuance is really a vote of confidence by investors, fund managers, governments, and now that reach is global. That made me think about what happened recently with Japan. When the yen recently came under pressure, there was concern that Japan might have to start selling US Treasuries. The US couldn't let that happen, so they stepped in and used euros to buy Japanese yen by the billions. That was to help stabilize the yen situation. You see, they needed to protect the dollar in the US Treasury market. To me, that's another reminder that this isn't just about one country's debt anymore. Everything is interconnected. Understand that a shift in confidence can happen slowly and then suddenly. And that's where Martin Armstrong believes we're headed over the next several years. Not necessarily towards an immediate collapse, but towards a world where confidence in sovereign debt becomes increasingly difficult to take for granted. One thing I probably should explain is what I believe Martin's computer program is actually looking for. I don't think it's trying to predict tomorrow's stock market or interest rates. I think it's looking for cycles, patterns that have repeated throughout history. Things like capital moving from one country to another, changes in confidence, and the way governments, markets, and investors tend to behave under stress. In other words, it's less interested in today's headlines and more interested in the bigger forces underneath them. And that might help explain why Martin Armstrong kept coming back to debt. Because from his perspective, it seems that enormous debt is potentially a huge ticking time bomb. If you think about it, money doesn't disappear, it moves. One thing interesting about Martin Armstrong's interview is that he doesn't see financial crises the way most people do. We tend to think in terms of markets going up or markets crashing. He thinks in terms of capital moving, because money doesn't just disappear. It leaves one place and it shows up somewhere else. That's happened throughout history. When investors lose confidence in one country, they don't usually pull their money out of the financial system altogether. They simply look for somewhere they believe is safer. And that's why he says that sometimes you can see something that seems contradictory. Gold rebounding, the US dollar staying strong, even the US stock market continuing to make new highs. At first, that doesn't seem to make much sense, but it does if you think about where global capital is trying to go. It's not necessarily chasing the highest returns. Sometimes it's simply looking for a safe place with the least amount of risk. So why gold? This also helps to explain why Martin Armstrong is very bullish on gold over the coming years. He doesn't talk about gold because he expects inflation to suddenly spiral out of control. He kept coming back to confidence. If governments continue borrowing more, if investors gradually begin demanding higher interest rates, if confidence in sovereign debt slowly starts to weaken, then capital will have to move somewhere else. And historically, one of those places it has gone to is gold. Its purpose has been to preserve purchasing power during periods where confidence in governments or currencies begin to fade. That's a very different way of looking at it. And it also explains why Martin doesn't believe gold's biggest move is happening today. He believes the larger move comes later as these debt problems continue to build over time. Whether his timing proves to be exactly right, none of us knows, but I do think he's asking the right question. What happens if confidence continues moving away from paper promises and towards hard assets? Martin Armstrong also questions whether the foundation underneath the financial system is beginning to change, not overnight, slowly, almost quietly, because confidence rarely disappears all at once. It fades, and when it does, people begin making different financial decisions. Investors move capital, central banks buy more gold, and I think we're seeing that now. Governments pay higher interest to borrow. None of these things by themselves prove something like a crisis might be coming, but together they may be telling us something. So let's come back to where we started. Martin Armstrong built a computer model that spent decades looking for repeating patterns throughout history, patterns in markets, patterns in governments, patterns in human behavior. And according to Armstrong, that model is pointing towards something much bigger than another recession or another bear market. It sees a growing sovereign debt crisis, rising geopolitical instability, increasing capital moving towards safe haven assets, and a long-term bull market in gold that could continue well into the early 2030s. Perhaps the most striking prediction of all is what comes next. Martin believes the years leading up to 2032 represent a major turning point, not just financially, but politically. He argues we're approaching the end of one cycle of government and the beginning of another. I know that's a bold prediction. Time will tell whether he's right or not. I'd love to hear what you think. Is Martin Armstrong seeing something that most economists are missing? Or do you think his conclusions have gone too far? Let me know down in the comments. And if you want to know what he and other top economists think about the future, 2026 and beyond, then you need to watch my economic roundtable video right up here. Thanks so much for watching, and I'll see you in the next video.